All right, excellent. We are doing really great. And it's time for another practical exercise that will reinforce what we've learned here. Let's solve it together this time, shall we? Company X acquired a tangible asset for $25,000 at the beginning of 2017. The tangible asset has a 5-year useful life. Precisely 2 years later, in 2019, the asset was revalued at $12,500, and its expected useful life remained the same. Then, a year later, the asset was revalued to $12,000, and its expected useful life remained the same. Here's our task. How are we going to account for the asset's revaluation? And what is going to be the difference in the way we account for its depreciation? The first thing we need to do is calculate the carrying value of the asset. Its original cost was $25,000, and its useful life is 5 years, which means that the asset will be amortized $5,000 per year. After 2 years, the carrying value of the asset would be equal to $15,000, as a depreciation of $10,000 would be accumulated. The $15,000 carrying value is greater than the $12,500 fair value we have, so this will be a downward revaluation of $2,500. However, before we continue further, we need to clear up accumulated depreciation. The way to do that is by debiting accumulated depreciation for $10,000 and crediting the asset for $10,000. This doesn't make any changes to the balance sheet. Right, let's report the effects of our revaluation. We'll have to debit revaluation loss $2,500 and credit the tangible asset for $2,500. Okay, now we just need to adjust the asset's depreciation expense. It is now worth $12,500 and has 3 more years of useful life. Therefore, we'll depreciate it by $4,166 annually. Hence, the next year's asset carrying value will be $8,334. However, a new revaluation takes place, and the asset is now revalued at $12,000. This is an upward revaluation, correct? Okay. Previously, we registered a revaluation loss of $2,500. Such a loss, according to the principles of conservative accounting, goes to P&L. Instead, when an asset is revalued upwards, things are a bit more complicated. If no revaluation loss has been registered previously, we have to report the upward valuation in other comprehensive income, which is an equity account, in its entirety. It doesn't show up in the P&L statement. If, on the other hand, we've already registered a revaluation loss, which is the case in this exercise, we can compensate for such loss reporting a revaluation income of $2,500 in the P&L. In our case, the upward revaluation is more than $2,500, which means that a part of it will be reported in the P&L, and the rest of it will go directly to other comprehensive income. To be precise, $2,500 will go to P&L, and $1,166 will go to OCI. Makes sense, right? Before we make any revaluation entries, let's clear out depreciation. We have 1 year of depreciation for $4,166. I'll debit accumulated depreciation for $4,166 and will credit tangible assets for the same amount. The accounting transaction for the revaluation taking place in 2020 will be debit the tangible asset for $3,666 and credit revaluation gain for $2,500. This line goes into P&L, and credit revaluation surplus for $1,166. which goes to other comprehensive income. As you can see, once we reversed the loss sustained through downward revaluation previously, we continue to send upward revaluation in OCI. This pretty much wraps up our exercise. That's how we account for revaluation. Thanks for watching.